Hey everybody, today I'm going to be doing a video on how to build a simple diversified income portfolio. So this is after you've decided this is the strategy you're going to look for, what kind of things you're going to look to put in it, what kind of allocation, things like that. This will mostly be for people on the younger side, your 18 to 34s, because there is going to be a large bit of equity and other riskier investments. So if you're on the older side or the super safer side, this might not be for you. But if you're okay with a little bit of risk, this could be something to look at. So let's get started. First, the goals of an income portfolio are, first of all, to create a stream of current income. This is your first goal. This isn't dividend appreciation investing. This isn't capital appreciation investing. You're trying to get a stream of income, something that you can live off or something that you can do with the income that you get, that kind of thing. Your second goal is capital preservation. That is, the money that you put in, you want it to be relatively safe. What you put in, you want to maintain its level of value. You don't want to lose a lot. And our last goal is capital appreciation. This is not a main goal, but we do want our portfolio to increase in value over time. However, this will be much less than other strategies such as growth strategies or anything like that. The first part of our portfolio will be the largest, and that will be equities. It should account for about half to 60% of your portfolio. This can be anything from dividend-focused ETFs, personal dividend stock picks, or a mixture of the two. It could be anything depending on what kind of dividends you like. If you're looking at large cap, small cap, if you're looking for something with a bit of dividend appreciation, or you're just looking for that relatively high yield, that's okay. Just make sure that you focus on quality over yield. Don't go for a bunch of 10% dividend stocks that have a chance of failing when you could just get some 3, 4, 5% ones that are very stable. This doesn't mean that there aren't dividends that are going to pay 6, 8, 10% that are going to be quality, but you need to keep in mind that you're looking for that quality over the yield. The second part of our portfolio will be our higher income strategy positions. One of these is going to be something like a covered call ETF. For anyone who doesn't know, that is an ETF that essentially writes options, covered calls. They buy securities and then write the calls for them, and you get dividends based on the premiums they get back. These are going to be very high yield positions, often somewhere between 8 and 12%. They should account for somewhere between 10 to 20% of your portfolio. Not a large amount, but a good enough amount that you're getting that 8 to 12% is giving you a good amount back on that investment. This does remove the hassle of trading options because it does it for you. However, there is very little to no capital appreciation with these. They generally maintain their value and appreciate slightly as the market appreciates. However, when there is a market downturn, they drop as much as the market, so be aware of that. They do work best for sideways markets. So if the markets are trading sideways, you're going to be getting that 8 to 12% while the S&P is doing 0 to 2%. Our second high income position will be something like preferred stock ETFs. For anyone who doesn't know, preferred stock is essentially something like a stock and a bond put together. It's a little complicated. We won't go into that here, but we'll go over the basics. Again, this should account for about 10% of your portfolio. They are relatively high yield. They'll usually yield somewhere between 4 and 5%. They do attempt to maintain their share price, so you won't see very much fluctuation in the share prices. And if you have an ETF in the ETF prices, they'll stay roughly about the same. Again, there'll be very little capital appreciation. It will appreciate slightly over time, but very little. And again, this is something for sideways markets. Going into more of our debt side, we can look at high yield bonds. These can be high yield bonds of any maturity date. Do what's best for you. If you're better with short-term bonds, if you like long-term bonds better, that's fine, whatever you want to do. Again, you're looking at about 10% of your portfolio, and these are also going to yield about 4 to 5%. These will appreciate a bit better than our last two options, still not nearly as much as stocks, but they will appreciate over time. They also tend to move in the same directions as stocks as opposed to bonds, so keep that in mind, that when the market is going well, high yield bonds will generally do well in capital appreciation and vice versa. And finally, we're going to look at investment grade bonds. Now, these aren't very high yield. Generally, you're going to be looking at 2 to 4% based on the ETF you use and based on the maturity. Again, this should be about 10% of your portfolio. and they will also slightly appreciate over time. This is mostly going to be used for two things. One is a hedge against downturns. If the market fails, these will fail less. For example, short-term bonds will only drop usually a very small percentage compared to the wide market. The other thing is you can use this essentially as, instead of holding a cash position in your investment account, you can hold your cash here, get that 2 to 4%. If you see the market's moving and you want to go even more into your dividend equities, you could use the money from here. Now let's go look at a portfolio. So as you can see here, I made a little portfolio for us. We have our dividend ETF here. I chose the SCHD. You don't have to. It could be anything you like. Again, you could do a small cap dividend, a mid cap dividend, a dividend aristocrat ETF, whatever works for you. I like SCHD, so I went with that. For our high income strategies, I went with RYLD. That is a covered call ETF on the Russell 2000. There are a lot of covered call ETFs. There are some that go for the S&P, some that go for the NASDAQ. Again, do what you like. It's up to you. For preferred stock, I went with PGX, which is the Invesco preferred stock ETF. Again, tons of different preferred stock ETFs. Do what you like best. It has companies that you like, that you think are going to do well. Go with that, whatever works for you. For high yield bonds, I went with WFHY. That's the Wisdom Tree US High Yield Corporate Bond. Again, there are tons of high yield bond ETFs. I like this one because it doesn't move very much and it has a nice roughly 5% yield, so it works for me. For our investment grade bonds, I went with ISTB. That's a short term bond ETF. This one is not just investment grade bonds. It's investment and a few high yield junk bonds. But I like short term bonds because they have very little interest rate risk. So this is really more of a cash store for me. It's only at about 2%, but that's okay. I'm okay with leaving that there as a bit of a hedge. And then for the remainder of our portfolio, I took about 20% and split it over 10 stocks here at 2% each. My only requirements were that they had relatively good financials and at least a 3.5% yield. This portfolio took me far less than a day to come up with, less than an hour really. It's very simple, just a little bit of screening, a little bit of research, and you can make an income portfolio very easily. Now, if we go over to the actual dividends from this portfolio, we can see that I've made it here, as we can see all of our holdings. We're hitting about 5.2% dividend yield. It was a little bit higher, but the market moved upwards recently, so the dividend yield shrank a little bit. But if we go through our positions, we can see that we're ranging anywhere from, we've got 5%, 8.5%, 5%, almost 4%, 2% for our bonds, up to 12-ish%. So this is going to do a lot better than a dividend appreciation strategy in terms of income, where you're really looking at 2 or 3%, but looking to make money over time. This is really about getting income now. If you're really looking to help pay your monthly bills, or maybe you're trying to finance a vacation or a purchase or something like that, you want to get income to pay for other expenses like that, this could be a way to go about it. As we can see, I had a $100,000 portfolio here, and you're looking at $5,300 a year. That's $5,300 of income. Some of it's qualified, some of it's not, depends on the holding, but that's an extra $5,300 to pay your bills, to pay for things that you want to buy. This is something, if that's your strategy. If you're not looking to wait 40 years for your dividends to appreciate to a point where you can use them, this might be something for you. If not, if you're looking for a lot of growth, this isn't going to do much for you. The equities that are in there will appreciate over time, but it's only about half your portfolio, so you'll trail the market. This is really, if you're looking to get money now, to do stuff with, this is the strategy you're looking for. I hope this helps, and thank you for watching.